So in order to determine the total principal repayment on the new additions, it's going to be equal to the sum of all of those. So we begin with empty cells and we can fill it to the end of the projected period. So we have that in place. Now, to determine the lease payments on new lease liabilities, as I said before, that the lease payment is like the total debt service for the new leases, so it has to include the interest. So in this case, we will just take whatever the principal repayments were, and then we add the portion to interest. And we can now fill that right to the end of the projected period. So the ending balance on new lease liabilities is going to be equal to, we take the beginning balance plus the additions plus the interest, and then we deduct the principal repayments. We can fill that right to the end of the projected period. So now the total ending balance, including the existing leases, is going to be equal to, we take the total ending balance we calculated a while ago plus the ending balance for the new leases here. So we have that set up. So we can fill this right. So the beginning balance for the new leases is going to be the ending balance of the prior period. So we have that in place. So the beginning balance of this period is going to be the ending balance of the prior period. So when we do that, we see that we have that portion of interest calculating going forward. So we can see the portion of interest is kicking in here. Then, since we need the total interest expense later on in our income statement for this payment of the finance lease liability, we also need the total principal repayment that will appear in our cash flow statement. So we're gonna sum the interest expense that we calculated in the existing side of the finance leases. We add that to the new leases. So the portion of interest for the existing and the new leases, we have that in place. And then for the total principal repayment, it's gonna be equal to, in this case, we will take the negative of, as I said before, we take the total lease payment on existing lease liability. We have to deduct the interest as a result of that, because we are accounting only for the principal repayment. Close that, and then we will have to also add the principal repayment on the new additions here. So we are actually just adding in that, so we are just taking that in a negative because it's negative there. So we add in the principal repayments of the existing lease liability and the new leases. So the principal repayments of both the existing and the new leases. So we have that in place. So we can fill this to the end of the projected period. So we're gonna be bringing this later on in our cash flow statement. So having done that, we have done the finance leases. We can move on to our operating leases. So for the operating leases, we have also, just as we did for the finance leases, we have the right of use of assets, and then we have the operating lease liability. So for the right of use of assets, it's gonna be for the amortization on the existing right of use of assets under the operating leases, and the amortization on the new right of use of assets under the operating leases is gonna be based on the lease liability. So it's just a plug. That is to say, it's just simple to determine, because we're just gonna be taking the lease payments, that is the total debt service, or we're gonna be taking the lease payment, or that is the total debt service. We're gonna be taking that, and then for the existing and for the new right of use of assets from the finance leases. So when we are done with the operating lease liability, in order to do this, it's gonna be very, very simple. We'll just be linking whatever amortization on existing right of use of assets will be based on the existing lease liability, and the amortization on new right of use of assets is gonna be based on the new leases under the operating lease liability. So let us begin with the operating lease liability here. So just as we did with the finance